we have some ground left to cover here, and cover it we will.
The U.S. Fed hikes rates by 75 basis points to take the Fed funds rate to its highest since 2008. Stocks initially rally but soon sell off as a hawkish Jerome Powell suggests the fight against inflation is far from over and expects that ultimate level of interest rates will be higher than anticipated earlier. Stocks in the Asia-Pacific open lower after Wall Street sells off. For the India market, the SGX Nifty is indicating a weaker start near the 18,000 mark. U.S. inventories continue to decline, but crude cools to below $96 a barrel in early trade today. This even risk assets take a beating after Fed raises rates by 75 basis points yet again, and Fed Chair Jerome Powell sounds more hawkish than expected. The RBI's Monetary Policy Committee will meet today to discuss its first ever inflation target miss. Governor Shaktikanta Das confirms the meet will solely focus on the letter to the government over missing the inflation target. Says it is up to the government to make the letter public. And watch out for second quarter numbers today from Nifty biggies like HDFC, Hero Moto and Adani Enterprises. Also watch out for numbers from chemicals giant SRF. Good morning. You're watching Power Breakfast. I'm Sonal Bhutra coming to you live from the Mumbai News Center. Those are the top headlines that we are tracking this Thursday morning. A lot to catch up on. But first up, as always, let's take a look at the Asian markets. They are reeling under some pressure, of course, after the hawkish commentary coming in from the Fed. They have raised rates again by 75 basis points. And that is something that is impacting the markets. Yes, of course, there was an initial rally in the U.S. markets, but commentary was quite hawkish. And that's why we are seeing some impact here. The Taiwanese index sitting with cuts of 1%, Hang Seng is down 1.5%, and that is the situation across the Asian markets. We have Straits sitting with cuts of 1%. We also have something like a Shanghai, which is deep in the red right now. And a result of all of this, the SGX Nifty is indicating that the start for our market could be near that 18,000 mark. A 160-point downtick is what this particular index is suggesting. It could be a gap down opening for our own markets today. But let's talk about the big news overnight. The U.S. Federal Reserve hiked interest rates by 75 basis points for the fourth time in a row. The central bank also signaled rates are likely to go higher than previously forecast. CNBC's Steve Leisman with the highlights and takeaways from the Fed decision.
Yeah, Kayla certainly highlighted the most important part right there. And it looks like there's two pieces to it. The first one here, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and economic developments. So the first part, the part I didn't read, is they want to make sure it's sufficiently restrictive to return policy. So that tells you maybe they have more work to do. But the idea that maybe they're taking into account lags tells you maybe they're going to go slower here. I don't think I would mistake this for saying the Fed is ready to pause. I think it's something that you might digest and say the Fed is aware that it's done an awful lot and doesn't feel it has to do quite as much as it had done in the past. I'm going to take a quick look while I'm talking here at what's happened to Fed fund futures, and they've come down a little bit. We'll see if that holds, but that May contract was trading at 503 for a high for a peak funds rate. Now it's at 496. So not much of a change, but a little bit of coming off there. The market still is reading this, at least in the initial minutes after the statement came out, as believing the Fed has still considerable work that it will be doing. So maybe a slower pace, but I'm not seeing necessarily a lower peak.
Okay, all right. That is the analysis of whatever was decided yesterday. In fact, let's listen in to some reactions to the Fed's monetary policy decision that came in.
I do worry that it's premature to talk about slowing down increases in interest rates. Realize that we're still at very low interest rates relative to inflation, and that's the key. That in order to deal, and also that the Fed got behind the curve up until recently. I have to tell you, I think they performed extremely well in terms of really turning 180 degrees. They made huge, I think, very major mistakes, which I've been talking about for almost a year and a half. But they now have got their act together. So we're in a situation where any projections of what we think inflation will be over the next couple of years is certainly above 3%. Maybe we'll get lucky. And so this is telling us that the Fed needs to get at least to 5, and I think even higher than that.
The thing that surprised me most was that we got a fair amount of soft guidance of how this cycle is likely to play out. And I think the committee and Powell set the table for a step down in December, but he's not going to commit to that. It's not, it's not a sure thing, but he certainly kind of began the preparation of the markets for that possibility. But at the same time, hawkish in saying that they have a long way to go yet.
This was expected. He basically, the Fed raised interest rates as expected, but Chairman Powell also came in with, slight mollifiers for the market. Yes, over the next meeting or two, we will start slowing the pace of rate increases, but we're going to go higher than you expected. Because, he did say that we haven't seen much of an effect on inflation yet, and the labor market is red hot, so we need to do more. I think the one additional piece of dovishness was we don't need to see inflation come down significantly before we slow the pace of rate hikes. So that, for a while, the market took some comfort from that. But in general, it was relatively hawkish.
Recession is easily 60% in the next, I'd say, 6 to 8 months. And for the year 2023, I'd put it more like at 80. What's happened in the bond market, and the treasury market is part of this, so is the stock market, intertwined. We entered this year with no yield anywhere, and stocks wildly overvalued versus their own metrics historically of PEs and book price to book and all that. And as overvalued as stocks were by historical comparisons to stock valuations, they were actually cheap to bonds. Bonds were just terrible, but not anymore. Everything has changed. Stocks are, of course, way less overvalued than they were at the beginning of the year, but bonds have done really badly.
Okay, it is time to listen into what U.S. Federal Reserve Chair Jerome Powell had to say. Listen in.
I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will. We'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. We're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. It used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? If we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think.
Okay, that's the word coming in from Jerome Powell. And reacting to the Fed decision, Wall Street ended yesterday's session lower. The Dow Jones closed 1.5% lower, the S&P 500 down 2%, and the tech-heavy Nasdaq fell harder with an over 3% cut. CNBC's Sarah Eisen gets us a wrap of all the action on Wall Street.
Here on Wall Street, stocks ended lower after the Federal Reserve raised a key short-term rate by 0.75%. It's the fourth straight big increase by the central bank. But it was widely expected. The selling came after Fed Chair Jerome Powell made it clear during his post-announcement news conference that the Fed has no plans to pause those hikes, as some investors had been hoping, saying, "We have a ways to go before inflation is tamed." Market wasn't expecting something that strong, and it did send stocks lower on the day. You can see the response in the chart, with the Dow closing down more than 500 points, around 1.5%. The S&P 500 finishing with a loss of 2.5%, and the Nasdaq getting hit the hardest, dropping 3.33%. Employers are beginning to scale back on working from home. LinkedIn telling CNBC.com remote job listings have dropped by 5 percentage points since peaking at 20% in April. But it's still much higher than before the pandemic, and more than half of all the applications are responding to those remote job postings. That's the action from the U.S. market. Back to you in Mumbai.
Okay, all right. That's all the action from the U.S. markets for now. We'll slip into a short break. The RBI's Monetary Policy Committee will meet today to formulate a response to the government of a missing inflation target. Details on the other side of the short break. Welcome back. You're still tuned into Power Breakfast. Well, we spoke about what the Fed rate decision was, how it impacted the U.S. markets. But of course, let's talk about how it will impact our own markets. We have our research team joining in with what the trade setup looks like, the stocks that are likely to be in the news, and the action from the F&O space as well. Hey guys, a very good morning to all of you. Vivek, first up to you. What is the impact on our own markets?
Well, good morning. It's expected to be quite a soft opening as far as the Indian markets are concerned. Like you rightly mentioned, most of the U.S. markets ended quite deep in the red after seeing such a sharp spike up, immediately post the rate hike decision. Now, when you're talking about, the comments, main problem was that as far as equity markets were concerned is that the commentary that the terminal rate hike is going to be likely higher than anticipated has actually set equity markets into a tailspin downwards. Now, when you're talking about the European markets, most of the European markets, closed just before the decision, and which is why, while they ended lower, when you're talking about European markets, they still haven't seen the kind of deep cuts that the US markets saw. Gold prices fell down marginally once again, and when you're talking about crude oil prices, however, went up. And when you're talking about Brent as well as WTI crude, both went higher by close to 1% in yesterday's trading session. Key events today to keep an eye out for as far as Indian markets are concerned continues to be Q2 results. When you're talking about some of the key results, HDFC, Adani Enterprises, Hero Moto, HPCL, and also SRF amongst the larger mid-caps are the ones that will be declaring the results. Most of the Asian markets are indicating a very soft opening, and in fact, the SGX Nifty 2 is indicating quite a deep gap down opening as far as Indian markets are concerned.
Okay, all right, Vivek, thank you so much for all those cues. Surbhi is joining us now. A lot of stocks in focus as well. Surbhi, over to you.
Few stocks that are on my radar today. The first one is M&M Financial, where the operating profit has come weaker at 864 crores. The gross NPA ratio is lowest in 14 quarters at 6.7%. The net NPA ratio is lowest in 29 quarters at 2.91%. Dalmia Bharat, where the revenues come in at 2971 crores, the EBITDA is coming at 377 crores, and the margins have come in at 13%. Next is Triveni Turbine, where the revenue is up 42%, the EBITDA is up 39%. Margins have come in at 23%, and the order book for the first half stands at 719 crores. The board has also approved a buyback of 190 crores for 350 rupees per share. Next is Relaxo, where the revenue is down 6.3%, margins are down 748 basis points, and the PAT is down 67.4%. MTAR, where the revenue is up 38% and the EBITDA is up 19%. JK Paper, where the revenue is up 74% and the EBITDA is up 146% on a year-on-year basis. Lastly, JK Cement starts operations in its Madhya Pradesh unit. Few other stocks that will be on our radar today as they're going to announce their Q2 results are HDFC, Hero MotoCorp and SRF.
Okay, all right. Surbhi, thank you so much for that list. Let's talk about the F&O space now. Today is the weekly expiry as well. Mangnam is joining us with all those cues. Good morning, Mangnam.
Good morning. The SGX Nifty is indicating a very sharp downtick as we open, closer to that sub 18,000 mark at a spot level. In fact, even at the futures level, now it's down almost 175 odd points. And that will be extremely important to watch out for, primarily because yesterday, ahead of the Fed meeting, the FIs lightened their positions in the F&O space. They unwound close to around 10,000 longs in index futures. They unwound around 28,000 long calls in index futures, so perhaps did not want to keep any positions open. Importantly, a lot of the short positions also, both calls as well as the puts, were unwound, and at the same time they sought some protection, so they've bought around 11,000 long puts. So to that extent, it will be extremely crucial to watch out for the first hour low in today's trading session. FI has bought around 1,400 crores in the cash market, but remember, this was yesterday ahead of the Fed meeting and the Fed announcement. So this is another trend that we'll be watching out for. It is weekly options expiry, and the game today will be that of the 18,000 put, which is the maximum open interest, 76 lakh shares outstanding at a premium of around 40 odd rupees. So that's telling you that, the street is expecting that there could be some support just below that 18,000 mark. But if that doesn't happen, unwinding by those put writers could lead to further sell-off, and we'll perhaps then be testing that 17,750 to 17,800 zone, which was earlier a congestion and now perhaps maybe a bit of a support. If not, then perhaps we go all the way down to the 20 and the 50-day moving averages. 17,500 thereabouts will be an important level to watch out for. The Nifty futures premium to the spot is around 64 odd points. Usually this is unsustainable, so that is something we'll be watching out for as well. Usually settles around the 35-40 odd points. And the Nifty bank as well, 41,000 put, has the maximum open interest premium at 150 rupees. So there would be some unwinding on those short put writers as well. So there could be further weakness. But all in all, how do you approach trade? Look at the first hour low, and if we see any sustained movement below the first hour low, then there could be further unwinding. Else there could be some bit of relief.
Okay, all right. Mangnam, thank you so much for all those cues. In fact, Surbhi, Vivek and Mangnam, thanks a lot for joining us today. With that, we talk about the RBI's Monetary Policy Committee meet, which will be meeting today to discuss its failure to meet the inflation mandate. Remember, inflation has remained above targeted 2 to 6% band for 3 consecutive quarters now. And after the special meeting, the central bank will write to the government explaining the reasons for missing the target and the measures it is taking to remedy the same. On that note, let's listen into what Governor Shaktikanta Das had to say about the inflation challenge on the sidelines of the FICCI IBA Banking Summit yesterday.
We are in a situation where, the inflation has remained above 6% for 3 consecutive quarters, and under the accountability norms which are provided in the Reserve Bank of India Act, we are expected to send a report to the government explaining explaining as to why it happened, what measures we propose to take, and by which time we expect inflation to come within the target range of 2 to 6% and closer to 4%.
All right, time to slip into a break now. Up next, we'll get you all the cues from the commodities market. Stay tuned. Welcome back. Well, impact on commodities as well on the back of this rate hike. So let's get in Manisha Gupta to explain all that to us and all the update from the commodities space. Hey, Manisha, good morning.
Morning, Sonal. Thank you for that. Well, as the statement started coming in from the U.S. Fed chairperson, we saw the asset classes move on both sides. But, within commodities, we've seen some support continue. After that initial knee-jerk reaction of a gain and a loss, now we seem to be stabilizing. So the crude oil prices still continue to hold around that 3-week highs. We're not too far away from $96 a barrel for Brent or even $90 a barrel for the WTI crude prices. This is because there is fall in the U.S. crude inventories. Not just crude, but there's a decline for the distillate inventories as well. And then the markets are looking at the OPEC and allies output, which also has continued to decline way below their agreed output. And then they are cutting extra from the month of November. Markets also are looking at the European Union embargo on Russian oil that starts on 5th of December. And remember, the winter period has just about started, so the natural gas and other distillate demand will only increase, and that is what is supporting the prices right now. Same is the case with metals as well. The U.S. Fed is done. It is about the Bank of England monetary policy meeting today that the markets will watch out for. And in the meanwhile, there is also Australia trade surplus, which has topped estimates. The Singapore private sector growth has hit a 3-month high. So when you look at the Asian economies, the data here still continue to be on the stronger side, and that in turn is supporting metals and precious metals buying today.
Okay, some support there. Manisha, thank you so much for explaining that impact to us. That's about the commodity markets. A quick look at what's happening in the Asian markets yet again, because they continue to reel under some pressure. We have Hang Seng, which is sitting with cuts of around almost, actually those losses have extended, so it's down 2.4%. The Taiwanese index also losing much more than what we saw when we started the show, down 1.2%. And the SGX Nifty, which was down around 150 points when we started the show, is down 170 points at the day's low, below that 18,000 mark as of now. We'll have to see which way things go for our own markets, but of course the start will be in the red for us. With that, we'll take your leave on this edition of Power Breakfast. Thanks a lot for joining in. Bazaar Morning Call comes up next.